Now, this question of how often, or you can say under what situations, should this tool of indirect tax be used is a question where economists and the government policy makers, sometimes they would agree, but many other times, most of the times I would say, they would disagree. Now, let us start off with the situation where economists and the government policymakers both agree that yes, indirect tax should be levied on a certain product. Now, the situation arises simply when the free market fails. So, FM for free market. When the free market fails, then economists and the government policymakers, they both agree that yes, this is a case where the government should interfere and put a tax on the product whose market is failing. Now, what do we mean by failure of the free market? Now, failure of the free market simply means that the system of demand, supply, and this whole price mechanism, it works in the usual way, but it ends up giving you an equilibrium quantity which is either more or less than what is the best from the society's point of view. Now, we will learn more about market failure and what exactly it means in the last section of this course. But for now, just think of it like this, that if this Q star happens to be the optimal quantity of this product that should be produced from the society's point of view, and the free market, the market system of demand, supply, and the prices, if that settles into an equilibrium where instead of Q star, this larger quantity is being produced, this is where we say that the market is malfunctioning and it is failing. It is, we say, overproducing this good, and therefore it is allocating more than necessarily the optimal amount of your limited resources on this product. And it is in this instance of market failure that both the government and the economists, they would agree that, look, the government should interfere, it should put an indirect tax on this product so that the supply curve will shift to the left. We will move to a new equilibrium which will bring the new quantity produced closer to the optimal quantity from the society's point of view. But that is the end of the honeymoon between the government and the economists as far as this question of should these indirect taxes be levied or not is concerned. Because if the free market, again, FM for free market, if this free market succeeds, or you can say works in the normal usual way, then economists and the government policymakers would disagree. And usually the position of the economists is that, look, if the free market is working normally, and it usually does, most of the times it does work normally, then economists would remind you of the efficiency of this properly functioning free market. They would remind you that, look, it is this free market equilibrium when the free market is being successful, working normally, that it is this free market equilibrium at which the sum of consumers and this producer surplus is going to be maximized, and therefore the welfare that the society can get out of this product, it's maximized when you produce this free market's quantity. Now, the government, it won't deny this, that the free market is not efficient, but the government will remind the economists of this classic trade-off between efficiency on the one hand and inequality on the other hand. Because you see, the thing that bothers government and that creates disagreement between government and economists is that government would tell these economists that, look, yes, your free markets, they are efficient, but that is all they care about. These free markets, they don't care about inequality. They totally ignore it. So even though your free markets are efficient, the government will tell the economists that still we want to interfere. We know that we will move this equilibrium away from the theoretically best optimal output, But then the government says that, look, we will be able to earn some revenue, and with that revenue, we will be able to redistribute wealth amongst the poor and therefore do something about inequality. So the government says that, yes, we know we are losing efficiency when we interfere through imposing indirect taxes, but that allows us to get revenues and help us remove these inequalities and redistribute wealth, which is a strong argument from the government's side. But still, economists, they don't sort of give the green signal to the use of indirect taxes. They still oppose indirect taxes. They still don't like indirect taxes. Because the economists, they would tell the government that, look, fine, you have to do something about inequality and you want to collect or gather some revenue, which is fine. But economists would tell the government that if your sole aim, the sole reason why you are putting indirect taxes is to collect tax revenue, then it is much better to go for direct taxation, such as income taxes, remember, instead of these indirect taxes. So let me put a tick here and a cross here. If the aim is to generate tax revenue, then go for direct taxes instead of indirect. And the reason economists would give for this is that they would tell the government policy makers that, look, these indirect taxes, they end up being regressive in nature, as opposed to these direct taxes, which they say will at least be proportional in nature. So proportional, a long word, I hate to write this word. They will at least be proportional, or at best, these direct taxes may end up being progressive. And that is what we now want to understand. This is the main goal of this video, to understand what is this proportional versus progressive versus regressive taxation. Now let me first of all revisit a simple example of an indirect tax, and from that we will first of all learn what is this regressive nature of taxation, and then we will move on to build an understanding of this proportional as well as progressive tax. Now, to revisit an example of indirect tax, let's assume that there is a certain soft drink on which the government imposes an indirect tax, the usual thing that we have been looking at in this section. Let's assume the government imposes a specific per unit indirect tax of, let's say, 10 rupees per unit of this soft drink. Now let's assume that there are two different customers who come and buy this soft drink. One of these customers, let's assume, happens to be an unfortunate poor guy whose income happens to be just 100 rupees. Whereas the other customer, let's assume, happens to be a rich guy whose income is, let's say, 1000 rupees. Now, assuming both of these consumers buy this soft drink, and let's assume that the entire tax has to be paid by the consumer, then as far as this poor guy is concerned, you see, he will pay 10 rupees as tax, whereas his total income is just 100 rupees. So in terms of percentages, he is basically paying 10% of his income to the government in the form of tax. So 10 divided by 100 into 100, 10% of his total income, this 10 rupees of income tax, is 10% of his total income taken away by the government. Whereas this rich person, when he buys the same soft drink and pays the same 10 rupees of per unit tax, then in percentage terms, this guy is only paying 1% of his total income to the government in the form of tax. So you see, already there is a problem here. This poor guy, and let's move on to this graph to elaborate upon this thing. And on this graph, let's assume we have incomes on the x-axis and tax rate on the y-axis. Now, tax rate, remember, is different from the amount of tax. By tax rate, what we mean is the percentage of total income that is going to the government in the form of taxes. That is what we mean by tax rate. So this poor guy over here, whose income is just 100 rupees, he is paying a tax rate of, let's say, 10% over here, so somewhere over here, whereas this richer guy, whose income is 1000, he just ends up paying 1%, so somewhere over here, 1% of his income as tax. So basically, you see, if you join these two, this is the sort of graph that you will see. This is what happens because of an indirect tax. The poor person who is earning a very small, meager amount of income, he pays the same amount of tax as this rich guy earning a much larger income. And what that means is that this poor guy is paying a much larger percentage of his total income to the government as tax, whereas the richer you get, the smaller the percentage of the income you are paying as tax. And that is where economists say that, look, these are regressive taxes, these indirect taxes, these taxes applied on a particular product. The poor end up paying a larger percentage of their incomes. So what is all this talk about interfering and disturbing the efficiency of the free market to redistribute wealth and help the poor? Because these regressive taxes, in a way, show you that you are sort of putting a much larger burden on these poor people than the rich. So this redistribution of wealth from rich to poor, this is not taking place smoothly through these indirect taxes, which happen to be regressive. Regressive, remember meaning, as your incomes increase, the percentage of your total income going out as tax, it starts falling. Now this is where economists, they would say that, look, if you still want to collect tax revenue, then it's much better that you go for direct taxes, because at least these direct taxes are likely to be proportional. Now, what is the meaning of a proportional tax? Now, let's go back to direct taxes. Remember, I said the best example of direct tax is income tax. And let's assume that the government, the country, has an income tax rate of 20%. And let's assume it's a flat 20% of income tax rate. Flat tax rate of 20% means that whether you are earning 30,000 or 60,000 or 600,000, the tax rate is going to be the same, 20% of whatever income you are earning. Now that would mean that regardless of whether you earn 100 or 1,000 or 3,000, you will have to pay 20% of your income as tax. So a flat rate of tax, not flat, but a constant rate of a tax. Now this is what is known as a proportional tax. So a proportional tax, where as you become more rich, the percentage of your income going out as tax, it stays the same. Now that is where we say that, look, at least these direct taxes, as far as this question of redistributing income from the rich to the poor is concerned, these direct taxes, these income taxes, at least they are proportional. At least the same percentage of income is being taken away from the rich and the poor, as compared to these regressive taxes, where you see the poorer you are, the larger the percentage of your income is going out as tax. So proportional taxes are better, but still they are not as good as they seem. Because you see, the way you think about these proportional taxes and why they are still not so much in favor of the poor is that if you take away 20% of a poor person's income, then you are hurting that poor person quite a lot. Because that poor guy won't be spending the last 20% of his income on some luxury product. He would perhaps be just trying to make ends meet and spend even those 20% that the government has taken away to fulfill his some basic necessity, some basic need. Whereas this rich guy who is perhaps earning millions, when you take away his 20%, then you see his 20% would have been most likely either going into savings or going on to some unnecessary luxuries and things like that. So even these proportional taxes, where you tax the same rate, the same percentage of income from the rich and the poor, even these are not really very good at achieving that redistribution of wealth through these taxes. And that leaves us with this last category, the progressive tax. Now, progressive tax, so let me explain. If you have an income tax, again, meaning that whoever is earning an income will have to pay a certain amount to the government. But instead of a flat rate of 20%, most of the countries, they have what you can say bracketed income tax. Now, bracketed income tax is where the government would tell you that, look, So anybody who earns, let's say, £30,000 or less won't have to pay any tax. But if you are earning between £30,000 and £50,000 a year, you will have to pay 20% as tax. If you are earning more than £50,000 every year, then perhaps you will have to pay 40% tax, and so on and so forth. That makes the same direct tax a progressive tax, meaning as you become richer, as your incomes increase, you will have to pay a larger and a larger and a larger percentage of your total income as tax. And that would mean that the graph for progressive tax would look something like this. An upward sloping line. That if you are poor, you will have to pay a tax, but it will be a small percentage of your income. But as your income increases and you become rich, you will have to start paying a larger percentage of your total income to the government in the form of tax. And this is really where you can see that redistribution of wealth taking place. So that is why you will often see these graphs and these questions around progressive versus regressive versus proportional taxation, and usually it will be just these graphs that you will see in MCQs. Now, you see the reason why this progressive regressive taxation is part of your A-level syllabus and why you see MCQs coming up is that in the real world, there is this real issue of countries and governments knowing that these indirect taxes are regressive and therefore not a very good way of redistributing wealth, but still countries go for these regressive taxes. Since all of these indirect taxes, as I just said, are regressive, and almost all the countries have some form of indirect tax in place, and sometimes the sole purpose is just to collect revenue. So why don't they go for this progressive taxation? Why don't they go for this direct tax, which is better at redistributing wealth? Well, you see, the issue is that it is difficult to collect these direct income taxes. Why? Because, you see, one of the reasons you can say is that these rich people who are earning millions and these rich firms and corporations who are earning billions of profits, they have access to the best tax consultants and tax lawyers and best advice, and they are even otherwise politically influential, and therefore it's easy for them, relatively speaking, to find loopholes in the taxation system and to somehow, avoid paying their taxes. So it's very difficult, especially in developing countries, where the government institutions are weak and corrupt. It's very difficult to collect these direct income taxes. And that is why the government is not left with any choice but to go for these indirect regressive taxes as the source of tax revenue. So it's basically, they are forced to do that. But otherwise, this thing that we have drawn here and what we are calling a regressive taxation, it really sort of dampens the whole aim of tax and redistributing wealth by generating revenues and doing things for the poor people.